several months, we expect to see silver advance to $300 to $500 an ounce. It sounds lunatic, I know. And gold, we're not sure where it's going, but it will go up less on a percentage basis than will silver at this point in history. Other markets out there will help generate this acceleration phase in gold and silver, where finally the average Joe on the street, an average analyst, will say, oh, now I understand why they've been going up. It's not global uncertainty. It's not what the Fed's going to do. It's because of this and this. And those thises are, one of them primarily, is the U.S. government, or government debts. We had a crisis in 2007 and 2009. It was predicted by a handful of young guys in the movie The Big Short. Shows that, where they knew there was a mortgage crisis coming. And sure enough, it took a couple years, but it came. And they were right, and people who laughed at them ceased. Okay, well, this time we have a different problem. We have a debt problem also in the commercial area and private debt as well, but we have government debt crisis. We know we've had one in Japan. They've had to bring out fire hoses. In fact, the new prime minister who was elected like a year ago, she said, we're going to have to print. Okay, lovely. Now, the Fed is sitting on the same time bomb. We analyzed the T-bond futures market, the 30-year bonds. They are the end of the timescale of debt that is least controlled by the central bank. In fact, when they cut rates, you can see oftentimes the bonds will go up in yield, T-bonds. Everybody's focused on, was the Fed going to cut now or whatever, blah, 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 blah. Today, I think there's, for instance, a sell-off because we had a high CPI number, I think largely due to the oil factor. Ultimately, there is a mandate out there that is unstated by the Fed. It's not unemployment. It's not the strong economy, weak economy. It's government debt crisis, and we have one. Now, Jamie Dimon, head of J.P. Morgan, a week ago, said that we're going to have a bond crisis, and we're going to have to deal with it. And he's speaking fundamentally, but he happens to be dead on target in terms of our timing of when that crisis is going to hit. If you look at the T-bond market, now remember, it's bigger than the stock market, much bigger. It dropped hard into 2022. Yields went up sharply. And it hasn't been able to get off the ground since then. 3 years of sideways bond, high yields, low price. We think that sideways bond price situation is now rolling over, and we're headed for another leg down, another upside in yields, which will create a bond market panic. The Fed will have to respond, meaning turn on the fire hoses because they have nothing else they can do. And they can't let the house burn down. The stock market seems oblivious to this, and that's a whole other issue. We can get into that if you want to.
Yeah, no, let's dissect that together. Let's define firehouses. Like, what kind of fire hose or what kind of fire extinguisher
I don't
does
know.
the Fed
Anything
have?
they can come up with. You know, they copied the Japanese back in 2008 when we had the crash in the U.S. stock market in October of 2008, a full year off of the bull high. It had already been in a bear trend for a year. And after that crash in October, and during that time, we also had failure of a couple banks, if you recall. The Fed came in with QEs. They took a page out of the Japanese textbook, and they started QE. Well, it didn't help the stock market then because it went down for another 2 quarters. It went down into March of 2009. Gold exploded. Gold had also dipped in October in sympathy with the stock market, although it had been going up before and after. It was just a 1-month phenomenon. But gold was back at its high almost immediately when they started QEs. And I think we're in that position now where the bond market event, which is not a headline event on financial TV channels nor among talking analysts and so forth. They're talking about the Iran situation, or they're talking about AI, or recently the semiconductors. Nobody's looking at the government bond market, or hardly anybody. Jamie Dimon is. And we think it's the crisis, the ambush that few are expecting. And when that one hits, it's far bigger than a mortgage crisis. And so the Fed has to respond. They have no choice. And they have very little they can do other than basically print in various forms. They'll be in there buying bonds. In fact, last November, the head of the New York Fed, Williams, made a statement that the Fed was going to start buying bonds. Okay, well, go back and look at the price of T-bond futures in November and where they are now. Yes, it's been slow, but they've gone down. Yields have continued up. So if they've been buying bonds, it hasn't helped. They need to turn on the fire hose more. And I think if you provoke the bond market through recent price lows or down to those lows, even right now, just for example, T bond futures are trading in the 112s. You get down to 111, much under 111, you're going to start to alarm even the price chart analysts out there who realize that, hey, this thing isn't holding. And that's when the headline will start to shift and the Fed will have to do something more dramatic. But also the stock market. The stock market's not oblivious to this. So far, they've not cared. If you look at the last year or so, while bond yields have remained high, prices low, stock market has continued to go up in a zigzag manner. We think it is in a major topping process, stock market, U.S. stock market in particular, and that what's on the other side of this is a major bear market. We don't think there's a crash event anytime real soon, but we do think you could possibly top maybe this month and ooze down such that if you end up closing this quarter out, meaning into this month, into June, and open the third quarter for the S&P, let's talk about, for example, it had a range-bound high at 7,000 for 5 or 6 months. Punched through that recently, despite the war, got up to 7,400. If you ooze back down under 7,000 again and get back below that distribution zone of prior price highs, momentum.
When you zoom out, this isn't really a gold story. It's a sovereign debt story hiding inside the bond market. Every major turning point in monetary history, from the 1970s inflation cycle to the 2008 liquidity panic, began with stress inside credit markets long before the public recognized it. What matters now is the convergence, rising yields, weakening confidence in fiat stability, and accelerating demand for monetary metals at the same time. The clip matters because it reframes gold and silver away from geopolitical fear and back toward monetary debasement. The argument is simple. Wars did not launch gold higher. Liquidity did. And when long-duration bonds begin losing credibility, central banks historically respond the same way: fast, aggressive, and inflationary.
And I like the fact that silver is leading here and gold is the laggard, because the spread relationship between silver and the mama monetary metal, gold, has massively disfavored silver for about a decade. There's the spread relationship between silver and gold. If you divide an ounce of silver into an ounce of gold and express it as a percent, if you went back to when we were $50 in silver in 1980, that spread was 6.5%, meaning an ounce of silver was worth 6.5% of an ounce of gold. When it hit 50 again in 2011, it was worth 3.1% of the price of gold. Right now, even though price is above those two highs, the spread has now broken out of a clear range that prevailed for the last 10 years. At about 1.4% was the ceiling level. You broke through that late last year. Right now, you're pushing up toward 2%. So we're still dirt cheap on a spread basis, silver versus gold historically. And when we measure the silver miners versus the gold miners, which one's better to be in terms of percent gain, the silver miners already broke out versus gold miners about 2 quarters ago. So what we see within the monetary metals is that the silver component, bullion and the miners, are highly likely to vastly outperform gold's continued bull trend. And I think it could be a very sharp outperformance, a jaw-dropping one. Again, gold might double from here easily. Silver, we're $85 right now. That we could see $300 to $500. We argue in the next 3 or 4 months, once we come up out of here. But the momentum metrics argue, that process is underway. The only one lagging right now is gold, and I would suggest that today's high that we saw intraday, and they dropped 2%, drop down from. You get back up there again on a close, gold saying, me too.
Interesting. No, I really want to follow that closely. Are there certain levels, like you just mentioned, those the 400
in our reports
levels?
we specify,
Okay.
I can't give them out here. Your people pay for this, okay?
Exactly,
but no,
as they should.
In general, we're in a transition, I think, up out of this ink. And you don't have to, you could wait if you want. But again, if you're not already long silver or gold, preferably from levels that we suggested. Like, for example, the last three buy signals we gave in silver based on long-term momentum was at $25 to $26 in March of 2024, $35 in June of 2025, and $56 at last November's close. That's it. We don't give any more long-term buy signals. But still, if you want to be in, there's a lot left here. And, you better consider getting in very soon and not waiting 3 months. Anyway.
No, that's good advice.
Okay.
One indicator I look at, because we follow it very closely, of course, here at Soar Finance, is the miners themselves.
Yes.
I'm trying to figure out what they're doing, especially the silver miners. They're quite volatile as well.
Yep.
What signal are they sending to you? Because usually
they're
the miners...
Yeah.
Yeah.
Silver miners versus gold miners, if you plot a chart where you divide SIL, ETF, silver miners, into GDX and plot every month's close going back 2020, let's say, when they had that surge back then, and plot that thing, you'll see that there was a basing pattern between 2024 and 2025 that it came up out of. So when you look at that chart, the relationship between the two, there was a clear breakout 6 months ago. And since then, if you bought silver miners, you're doing a lot better than had you bought gold miners. Same is true with silver. Silver had a sharp pullback along with gold since that January high, but the spread relation between silver and gold is holding its ground after a breakout that occurred last November. So that situation, and by the way, there's another metric we're watching. We mentioned it here. It's the overall gold-silver miner complex versus gold. XAU index has been around since the 1980s. It's the Philadelphia Gold and Silver Miners Index. When you plot it on a spread relationship, divide its price into gold, plot it at the close of each month, and go back into the 1980s, you'll see that it lived in a relative range of about, on average, 25% of the price of gold. In other words, XAU price was about 25% of an ounce of gold. In the 2015 collapse in gold, when gold went down to 1,050, the miners collapsed even more, and that spread went all the way down to 4%. Okay, it had lived for decades, about 10% on either side of 25%, up and down, but that was the average mean value of the.
After the clip, the key takeaway is not the prediction itself, it's the mechanism behind it. The analysis points to a bond market rollover similar to the setup before prior systemic interventions, where policymakers were ultimately forced to reopen liquidity pipelines because debt markets became too large to stabilize conventionally. That's why silver becomes critical here. Historically, late-stage precious metals rallies tend to rotate from gold into silver once momentum becomes public and speculative participation accelerates. The phrase used in the clip, verticality, is important because parabolic phases in monetary metals are usually brief, violent, and shocking. Verdict: this setup resembles prior monetary transition periods more than a standard commodity cycle. The bond market is larger than equities, more systemically important, and increasingly dependent on intervention to remain stable. Once investors begin treating sovereign debt itself as the source of instability, gold and silver stop behaving like trades and start behaving like monetary alternatives. The real risk is not missing the exact top in gold or silver. The real risk is being on the sidelines when confidence shifts from paper assets toward hard monetary stores of value faster than policymakers can contain it.